Welcome to today's Explainer. I am so excited to jump into this with you all because today we're going to look at something that really separates the amateur traders from the seasoned pros. We're talking about using a trading journal to uncover hidden performance leaks, and we're putting a massive spotlight on loss management. You know, if you want to actually survive and thrive in the markets, you literally can't just focus on the green. You have got to master the red.
So let me start off by asking you a really direct question. Do you actually review your losing trades? Or do you just celebrate the wins? Honestly, it's human nature to want to obsess over our winning trades. We love to see where we got it right, where our strategy played out perfectly, right? But true long-term survival in trading doesn't come from just patting yourself on the back. It requires actively dissecting exactly what goes wrong when a trade turns against you. All right, let's jump right in. Section 1, Hidden Trading Performance Leaks, and specifically, why win rate isn't everything.
You know, so many traders completely obsess over their win rate. They want a strategy that wins 80 or 90% of the time, but focusing exclusively on that is incredibly dangerous. A trader with a super high win rate but absolutely uncontrolled losses can literally erase weeks of hard-earned gains in a single afternoon. On the flip side, a trader with a lower win rate can achieve consistent, sustainable growth if their losses are strictly controlled. Controlling your loss size is the true secret to survival here.
Moving on to Section 2, Defining the Average Losing Trade, which is honestly the hero metric of survival.
So, what exactly is this? Well, the average losing trade is simply the mean dollar amount lost across all your closed losing positions. This is a core risk metric. It strips away all the market noise and reveals the raw truth. Are you actually maintaining your stop-loss discipline, or are you letting individual losses grow way beyond acceptable levels?
The math here is elegantly simple. You just take your total losses and divide them by the number of losing trades. But, and this is absolutely crucial, when you calculate your total losses, you've got to include every single dollar lost across those trades. That means factoring in commissions, fees, and slippage. This metric has to reflect your true, realistic cost of being wrong. Okay, before we get to the benchmarks, we really need to define 1R. Your 1R, or R multiple, is basically your predefined risk per trade. We use this to normalize our loss data. Why does that matter? Because a $200 loss means something entirely different to a $500 account than it does to a $50,000 account. By expressing our average loss as a multiple of our planned risk, our 1R, this data becomes totally relatable and actionable no matter the size of your portfolio.
Which brings us to Section 3, Benchmarks for Loss Discipline. Let's see exactly where you stand.
All right, time to grade your discipline. If your average loss is under 0.5 R, that is excellent. It means you've got killer discipline and consistently cut losses well before your hard stop. Good is between 0.5 R and 1.0 R, meaning your losses are safely contained within your predefined risk. Acceptable slips up to 1.5 R, showing some occasional slippage or late exits. Things are getting just a bit loose there. But if your average loss is greater than 1.5 R, you're firmly in the poor category. That means your risk management has completely broken down and your losses are regularly blowing past your planned risk.
All right, let's make this real. Section 4, a practical example using a $50,000 account. Let's look at the math in action.
Abstract concepts are great, but let's ground this with some concrete numbers. Imagine a standard $50,000 account. This trader's predefined risk, their 1R, is 1% per trade, which equates to exactly $500. Over 3 months, they take 60 trades. Out of those 60, 33 are losers. Keep that predefined risk of $500 in your head as we break down what happened.
So, out of those 33 losing trades, 20 of them hit the stop loss exactly, losing the planned $500. But we've got some extremes to look at. On the positive execution side, 8 trades were actually cut early for a smaller loss of just $300 each. Great. But on the negative execution side, 5 trades suffered nasty slippage, pushing the loss past the stop to $650 each. And when we add all of that up, the perfect stops, the early exits, and the terrible slippage, and divide by those 33 losing trades, we end up with an average loss of $474. Divide that by our planned $500 risk, and boom, we get an incredible final metric of 0.95 R. That lands solidly in the good benchmark range. Because this trader proactively cuts some trades early, they completely offset the damage caused by the slippage on those other trades. It's brilliant.
Next up, Section 5, Trading Psychology and Mistakes, the Human Element.
You know, math is perfect on paper, but we're human, right? We make behavioral errors. Let's rapid fire through the most common execution mistakes that inflate those loss sizes. First, moving stops mentally instead of just placing a hard order in the market. Second, averaging down on losing positions. Adding to a position that's already proven you wrong is literally the fastest way to produce outsized losses. Third, ignoring the reality of commissions and slippage. And finally, using way too small a sample size. You really need at least 20 to 30 losing trades before you can accurately judge your loss management.
Giving a trade more room. Honestly, how many times have you said that exact phrase to yourself? It is a fatal behavioral flaw. Widening a stop loss after entry transforms a tightly controlled risk into an absolute, uncontrolled disaster. Every single time you move a stop, you inflate your average losing trade and completely destroy the risk-reward ratio that justified taking the trade in the first place.
Let's look back at the anatomy of those 33 losing trades from our example. 60% hit the stop exactly, 25% were caught early, and 15% suffered slippage. This perfectly demonstrates how just tiny execution differences, like stepping in early on a quarter of your losing trades, can completely change the overall trajectory of your entire account.
Okay, on to our final piece, Section 6, How to Plug the Leaks. Actionable rules for consistency.
We know the leaks exist, so how do we actually fix them? I want you to walk away from this explainer with 4 actionable steps. Number 1, honor hard stops at entry, no exceptions. That completely removes the emotional temptation. 2, use time-based exits. If a trade stalls out and just isn't moving in your favor, cut it. Dead capital only inflates your average loss. 3, reduce your position size on B-grade setups. Just mechanically cap your dollar exposure. And 4, implement partial exits at warning levels. Scale out of losing positions if the setup thesis is weakening, rather than holding full size all the way down to the stop.
We've covered the math, the benchmarks, and those tricky behavioral traps. So I want to leave you with this final thought. Will you start auditing your worst losses this month? I highly encourage you to go into your trading journal, pull your 5 largest losses, and find the common thread without any emotional bias. Understanding your average losing trade is the absolute key to surviving the markets long enough to finally thrive in them. Thank you so much for joining me for this explainer. Stay focused and happy learning.